Hello and welcome to the latest Moneymakers Investment Trust podcast with me, Jonathan Davis. A reminder that for regulatory reasons, nothing you hear today, however stimulating and insightful, should be regarded as constituting individual investment advice or a specific stock recommendation. Them's the rules we have to work with. So this week on the podcast, something a little bit different, something we haven't done before, is talking to Jonathan Brachle, the co-manager of the J.P.Morgan US Smaller Companies Trust. This is a trust with a market cap of around 230 million as we speak. It's trading on a discount of around, well, it varies a little bit between 5-7%, something like that. And is one of a number of trusts which are coming up for a continuation vote next month. So it seems a good opportunity. Those continuation votes come up once every 5 years under the Articles of Association. Obviously, there's a lot going on in the world at the moment, particularly in the US markets. So that seems a good place to start. So first of all, welcome to the podcast, Jonathan. You've been involved in managing this trust since 2017. So let's kick off by talking just about what's been happening to the US market generally before we move on to how that's affected you. We know we've had, shall we say, a significant Trump effect over the last few months. That would be putting it mildly, I think.
Yes, I think that's true. And thank you for having me on the podcast, Jonathan. Yeah, I think last week was just a reminder of kind of the risks still facing markets after sentiment had swung fairly bullish in recent weeks. In mid-May, major U.S. equity indices were back in bull market territory. You had the S&P 500 actually up for the year at that point, and so it was almost as if President Trump's so-called Liberation Day never happened. Obviously, some good reasons for stocks to recover. You had the tariff delay remove some of the most extreme potential outcomes for markets. You've had that continued de-escalation trend with the UK framework and the China tariff truce, and then obviously at the micro level, a better than expected first quarter earnings reporting season. But I think many investors have been questioning whether this is truly an all clear environment or just a bear market rally. And I think President Trump's threat last Friday for 50% tariffs on the EU by June 1st and 25% tariffs on Apple if they don't produce the iPhones in the US was a bit of a reality check for markets, and as was the bond market's reaction to the House spending bill, which obviously pushed yields higher. So I think that just highlights we're still very much in an uncertain environment that's headline to headline, and sentiment can swing very quickly. And indeed, over the weekend, we did have another piece of tariff news with the EU tariff deadline pushed to July 9th. So we remain in a volatile environment, I think is the punchline.
Yeah, so on it goes, one could say. And that's not making it easy for a lot of people. It's not making it easy for corporates. It's not making it easy for investors either. So what's been the way that you've sought to manage this volatile environment?
Or yeah, I think the best way to put it is that we've been very incremental in sort of how we've approached it. I think it's hard to have a ton of conviction either way with uncertainty levels so high today. I think if we look at the first quarter and really through April, very defensive market and for good reason. So you had the highest quality, most defensive stocks outperforming and the most cyclical stocks underperforming. So I think at the margin, we found ourselves trimming some of those more defensive outperformers. So areas like certain REITs, utilities, healthcare services, and the like, and at the margin, recycling those into select high quality cyclicals. I think our general approach tends to be very incremental, so no deviation from that. And we do tend to sort of take what the market gives us at any given point. And so I think so far, at least through April, we did find ourselves incrementally leaning into cyclicals. I think our focus for our ads has been sectors that have already been in an earnings recession. So outside of a few areas like infrastructure and data centers, the broader industrial economy in the US has actually been in a downturn for the better part of 2.5 years. And we're certainly cognizant that demand trends could weaken further, but the starting point is already pretty low in many areas. And so we do feel that that provides some cushion. And then obviously, if the tariff situation does prove to just just be a minor road bump, then it's going to be the more cyclical companies that should benefit. So I think an example would be semiconductor companies, especially those with the broader industrial and auto exposure that, again, have already suffered from fairly soft demand trends. On top of that, it's really the AI names that have kind of sucked all of the air out of the room within semiconductors for the last 12 to 18 months. And so these names have been left behind despite having very good long-term content stories and things like electric vehicles, industrial robots, satellites, other applications within the electrification and factory automation themes. And so I think we're happy to add at the margin to companies like this at much more attractive valuations, especially in the peak of the sell-off in April.
So if I was an investor looking to invest in your trust, and I say you've got this continuation vote coming up, and performance perhaps over the last 5 years anyway has been, I think, relatively disappointing for you. Absolutely positive, but relatively slightly disappointing. Much better over 10 years. What kind of arguments would you be making? If I perhaps take them in order. Number one, why would I be looking to invest in the US equities at all at the moment? There's a lot of talk about people moving away from the US because of what's happening. We've had this very strong period for US markets. And then secondly, looking at small cap in particular, why we might want to consider investing in that asset class. So let's take the US market first versus the rest of the world. What's the story from that point of view?
I think the US equity market has been a story of a select group of very large technology companies in recent history, and other areas of the equity markets have not performed as well. And I do think it's worth maybe taking a bit of a longer term sort of perspective for small caps. No doubt the last 3 years has been very difficult. I think small caps have compounded something in the range of 1% for the 3 years ending 2024, driven especially by a weak 2022. But even including that, small caps have compounded at more than 10% annually over the last 15 years, which actually puts them near the top end of developed market equity indices globally. And even in the last 2 years, US small caps have compounded at 14% per year. I think the challenge has been really just the dominance of US large caps, with the S&P 500 compounding at almost double the rate of small caps over the last 2 years. But what I think that has left is a fairly compelling starting point for US small caps. I think, to your point, there is a lot of uncertainty in the macro environment in the near term, and certainly we lean a little bit cautious on that when thinking about the small cap asset class. But I think that the longer term horizon case is actually very compelling. I think if you're of the mindset that we're on the cusp of a potential regime change, potentially deglobalization trend, the benefits of globalization mainly accrued to large caps, right? They were able to show better relative margin expansion through moving production abroad. They were able to take advantage of tax arbitrage. And so a steady unwind of globalization could potentially have the reverse effect on large caps, with them potentially having more to lose. And as all these companies potentially reinvest back into the US, it's small caps that stand to benefit. Small caps generate about 80% of their revenue domestically. And just on the point of index concentration, I mean, the so-called Magnificent Seven is more than 25% of the S&P 500 market cap, which is near record levels. And if you look historically, extreme levels of small cap index concentration does tend to give way to strong small cap outperformance. We saw that in the case of the 1970s with the equivalent Mag 7, Kodak and ExxonMobil and the like. We saw it in the early 2000s with the Ciscos and Intels of the world. Those peaked to near similar levels of index concentration, and then small caps in both cases went on to outperform for multiple years. And I think it's interesting to think just Microsoft, Nvidia, and Apple each have a market cap that's greater than the entire Russell 2000 benchmark. So it really wouldn't take a ton of money movement from those names into small caps for it to be meaningful. So that's how I would answer that. And I think just the case for small caps in general, I mean, other than the obvious one for diversification, is small caps are relatively inefficient. I think the average small cap company has about 6 covering analysts. versus 20 on the large cap side. I think as of this morning, I looked, NVIDIA has 78 covering analysts. So I think it is an index that's ripe for stock picking. And I do think it's worth noting that every large company was one time a smaller company first. And so investing in American stocks and in US stock markets, particularly in small caps, can give investors the opportunity to maybe discover tomorrow's large cap companies.
I think it's fair to say that small cap underperformance in relative terms has been a global phenomenon. It's not just a US phenomenon, it's been a global phenomenon. And many people would say that's in some way associated to some extent with the fact that interest rates generally have been rising. Do you regard that as normally a positive or a negative for your asset class?
I think lately it's been negative. I think interest rates are up about 50 basis points on the 10-year since early April, driven by recession fears receding and fewer rates cuts being priced in, and then also deficit concerns. But I think high rates in general aren't necessarily a bad thing for the asset class. I think if you go back to 2004 to 2008, the 10-year treasury was 4% to 5%. So roughly in the range it's at today, and small caps did very well. I think what we need in the near term is just some interest rate stabilization. It's been a period of immense rate volatility, immense, macro uncertainty. And so some stabilization would go a long way.
And of course, obviously, if you're an investor over here in the UK looking at this particular investment trust, you have to have some regard to currency. What are your thoughts about the currency and how do you deal with that within the portfolio of the UK listed investment trust?
So obviously the US dollar is at its lowest levels since 2023. Again, deficit concerns, growth concerns, just general selling of US financial assets. But again, I think it's coming from a very strong starting point and still strong by historical standards. I think for the asset class as a whole, the weaker dollar could be relatively good in that it makes investment in the US by foreign countries less expensive. So I think that could be a positive. In terms of how we think about it for the investment trust, we're very focused on the bottoms up fundamentals for our companies. And so there's not a ton that we can really do about some of the macro variables like currency. So I think we try to stay focused on what it means for our companies in the portfolio.
Let me talk also about gearing. One of the advantages you have in an investment trust is you can use gearing. I'm just looking at the historical record here, and I think it's fair to say you've never used a particularly significant amount of gearing. If I look back over the last 10 years, it seems to be averaging around 5-6%. It was the highest it's ever been, I think, actually in 2024. How have you adjusted the gearing going into this current environment? Many people see that as a vote of confidence or optimism about your asset class. What have you been doing and how would you interpret that?
So I think we're kind of at the higher end of that range that you discussed as of the end of April, about 8%. The gearing discussion is something that we have with the board every time we meet with them. So 5 or so times per year, we consider things like the broader asset class outlook, cost of capital. As you mentioned, gearing is one of the advantages of an investment trust. And obviously over the long term, equity markets do tend to go up. So it does add value to shareholders above and beyond the asset class return. And then the potential downside to gearing is it can cause more volatility in down markets. But I think the hallmark of our investment process, which is very quality driven, is downside protection. So I think we protect naturally against some of those risks for gearing. And then, just having that gearing does help us to keep up a little bit more than we otherwise would in a higher beta market rally, which we generally expect to underperform in.
You are listening to a Moneymakers podcast. We are an independent research and publishing venture and grateful to J.P.Morgan Asset Management for their generous no-strings financial support, which enables us to keep the podcast free and our editorial principles intact. Each podcast episode goes live shortly after being recorded, with a weekly catch-up email notification every Saturday afternoon. Why not also try our premium weekly subscription Moneymakers newsletter, which provides a comprehensive summary of all the latest news, results and performance data from the investment trust sector, with links to the relevant stock exchange announcements if you want to go down that rabbit hole, and many other regular features including more than 170 in-depth and independent trust profiles, regular market commentary and videos, plus the editor's list of favourite funds. If you never want to miss a thing that might affect your portfolio, do please sign up today at money-makers.co. And if you follow this podcast on YouTube, please do use the subscribe and like buttons. Thank you. Now, as I mentioned, you've got this continuation vote coming up quite shortly. When you talk to investors over here, what kind of feedback have you been getting about that? Obviously, the board will have been in contact with some of the largest shareholders, but what's your perspective as one of the fund managers on how investors over here are thinking about the asset class and your performance?
Yeah, I mean, I think there's a fair bit of caution on the asset class in general. I mean, I mentioned earlier it's been a bit of a tough stretch for small caps in general, especially relative to large caps. Small caps do tend to be a bit more of an economically sensitive pocket of the equity market. And so I think concerns around tariffs and just the broader economy hasn't been helpful for sentiment for US small caps. So I think that's reflected in the conversations that we have with clients. And then, Jonathan, I missed the second part of your question on that. I'm sorry.
Well, they're cautious about the asset class. Have you picked up any thoughts about the investment trust itself? Obviously, it's 230 million. That's relatively small these days by the standards of what certainly wealth managers expect. Have you had questions about how viable this trust might be in that context?
No, I mean, we haven't had questions about the viability of the investment trust. I mean, if you go back, we did issue shares in 2021 with the trust trading at a premium. It did trade at a premium earlier this year. The board didn't issue any shares at that point, but in general, we have a good shareholder register. The board is very proactive in maintaining the tight discount. And so I don't think there have been questions on the viability of the trust from our investors.
Well, before we get to the end of this, you talked about some of the themes in the portfolio before. Perhaps you could just mention a couple of holdings about which you're particularly excited. I asked this question partly because I think most people investing here won't have heard of most of the companies that you invest in. By definition, it's a very large universe you're drawing from. And many of the names, as you say, trade mostly in the US, so they're not names you'll be familiar with. So give me a couple of examples of things that you're particularly excited about. And then perhaps we might talk about maybe a disappointment you've had as well.
Yeah, I mean, I think in general, we like to talk about small caps in general, and our investment trust is kind of the ability to invest in the heart of America. So, again, I mentioned the 80% of revenue coming from the US, but I think within small caps, you also get exposure to some interesting niches and business drivers that you may not find in larger cap companies. So, I think a good example in the fund is a company called MSA Safety, which is one of our top positions. We've known it for a long time, owned it for more than 5 years. So they're a manufacturer of safety equipment. A third of their revenue comes from breathing apparatuses and other protective gear that you would see on firefighters. Another third comes from devices that would detect gases in the air that are used by miners, oil and gas workers and the like. And then another third from industrial head protection and fall prevention equipment. So if you think about each of those categories, all very mission critical, non-discretionary areas, very stable demand trends over time. Demand, especially on the firefighter side, is often driven by regulations around worker safety, and it's often funded by municipal tax dollars, which don't move around a ton, fairly stable funding source. This is a business with very strong margins, low capital intensity, a durable free cash flow stream. So I think that's pretty emblematic of the types of companies that we would look to invest in. And those quality attributes are really the hallmark of kind of what we do. We're focused on durable cash flows and management teams that do the right things with those cash flows. And so I mentioned earlier, the fund tends to protect on the downside in times of market stress. And I think MSA Safety is a really good example of that. In terms of a disappointment, there's always stock selection mistakes. They happen every year. I guess one that would come to mind would be a company called Paycor, which is a software company that does payroll processing for small businesses in the US. That's a name that we purchased in 2021. It's a very profitable, high quality category with several large peers that show very strong levels of profitability. Paycor was a bit of a subscale asset within the space, and they had a new CEO that was reinvigorating the go to market motion and trying to sort of close the gap with peers from a top line growth perspective and margin perspective. And, it turned out that it wasn't as easy as we thought and as management thought to scale the business. And so, that one was a bit disappointing, and we did exit that name. But again, it wasn't for lack of high quality attributes. It was more the execution story didn't play out. And we'll have those from time to time. But yeah, that's probably how I'd answer that.
It's interesting. I think one of the things I noticed looking through the annual report, you break out how the portfolio breaks down by theme as well as by sector. And you have quite a significant exposure to what you've classified as climate change holdings. Do you think that's threatened by the kind of change in regime and perhaps, general popular attitudes towards climate change at the moment?
I think there's definitely been a shift in the winds in that conversation within the Trump administration. I think you can see that in terms of who's been appointed to lead the SEC. I think companies that we talk to still do talk about those types of things. I think maybe they just use different nomenclature than maybe they would have before. But you do see things like portions of the IRA bill being pulled back that funds some of these green energy investments. So I do think at the margin, those winds have shifted more away from that focus.
Perhaps I can ask you a little bit about AI, when it talks about AI and how it's a theme for the present and the future, and certainly has been attracting a lot of attention in terms of fund flows. What is your exposure to AI and how do you regard that? I noticed that you said in your annual report that one of your largest detractors was actually not owning one of these AI stocks. Perhaps you could expand a little on that.
Sure. So there's kind of two main themes that we've thought about with AI and small caps. I think number one would just be the scarcity within small caps. To date, it's kind of been the large caps that are the main beneficiaries. So you have NVIDIA, you have the hyperscalers, the companies that make the machines that actually make semiconductors. And then you kind of have this long tail of optical and networking and data center power and the like. And the second would be just that it's been very hardware and infrastructure driven, at least initially. And those tend to be tougher businesses in terms of customer concentration, margins, cyclicality, and the like. And the name that you mentioned, Supermicrocomputer, was a very big detractor for us. And for many, I think small cap managers last year, they're a manufacturer of servers and racks for data centers, and their kind of high end focus positioned them well for that initial AI land grab. It's a name that we were aware of, and I think for several reasons didn't meet our quality thresholds. So that was a name that we didn't own. We do have some AI positioning within in the portfolio. I mentioned earlier with the semiconductor conversation, our exposure tends to be more sort of industrial and auto exposed, which have very good long term growth attributes. Very high quality companies, and we tended to find data center exposure within small caps to be a little bit tougher. But we do have a couple names that have some good AI exposure, but also have the quality attributes that we look for. And I think a good example is one that we purchased in the spring of 2022 called Macom, which is a semiconductor company that basically makes chips that create and amplify data signals over very short and very long distances. So anything between a long haul wireless network and communication between AI servers. So they have about 25% of their revenue from the data center, but they also have about half of their revenue from this very stable, profitable industrial and defense exposed business. So we kind of get the quality attributes that we like, but also with some AI exposure. And, again, this name is extremely profitable. It's got a great management team, and it's actually one of the bigger positions in our fund. So, we do believe in the AI potential, but we do always stay disciplined to our process and try to find the most high quality ways to invest in any given theme.
So my final question to you, Jonathan, is this. I come back to this continuation of it. Obviously, you're hoping to pass that. And essentially, you're asking people to focus on the next 5 year outlook of this particular trust and asset class. I guess what you're saying is you're making that sometimes quite difficult argument that this is basically a contrarian point in the cycle, that small caps have done relatively poorly, and therefore the chances are, or the hope is, that they will do better over the next 5 years. That's not always an easy argument to make, but that will be the core of what you're saying.
Yeah, I mean, I think small caps have done poorly, again, relative to large caps. Like I said earlier, if you look at the last 15 years, they've actually been near the top end of the developed market equity indices. And yeah, I think the argument at its core, especially for long-term investors, is one of a very attractive starting point, right? I talked about the levels of large cap index concentration. We didn't talk about relative valuations for small caps versus large caps, which are a 25% discount right now versus a slight premium historically. Times like that historically have been a good entry point for small cap investors. So near term, definitely uncertain. Things could get worse. But I think if you do have a long-term starting point, it is an interesting time to look at small caps. And I think if we tie it back to kind of what we do, I think we offer investors a good way to get exposure to US small caps while also being able to take advantage of kind of the quality attributes that we offer and the historical downside protection track record that we have with our trust. And we certainly have had a bit of a challenging near-term performance environment, but we have outperformed in 12 of the last 16 calendar years. And we do think that a quality focused process is the right one over the long term. We do think when we get through some of this macro volatility and some of these animal spirits that we've seen in AI and crypto and some of these other things, when those things start to calm down, we do think quality is the place to be. And we think we offer a good option for that within US small caps.
Well, I guess it is fair to say that one advantage you have is that if you do want to invest through an investment trust structure into US small caps, there's only 2 companies to choose from, and you're one of them. And you have a slight edge in performance and size. So I guess that works to your advantage, and the discount is slightly narrower. So that was Jonathan Brachle, the co-portfolio manager of J.P.Morgan US Smaller Companies Trust, ticker JUSC, talking to me earlier this week.
Thank you for listening. The Moneymakers Investment Trust podcast is independently produced and edited and is freely available on YouTube, Apple Podcasts, Spotify, and other podcast channels. You can also sign up at money-makers.co to be notified of each new edition. If you want more news, analysis, interviews, and other investment trust content, don't forget to look at the Moneymakers Circle, available for a modest subscription at the website.